Welcome to Finance and Fortune, where we break down financial strategies that can take your investments to the next level. Today's video is crucial, especially if you're feeling uncertain about the market. We're diving into the world of bear market investing, and not just any approach, but the strategies that the ultra-wealthy use to not only survive, but thrive during tough market conditions. You've probably heard it said, the best time to make money is when others are fearful. But how do the wealthiest investors actually pull this off? What tactics do they use to navigate through the ups and downs of a bear market? Stick around as we uncover these secrets and give you actionable steps that you can use in your own portfolio. And hey, before we dive in, make sure to subscribe to Finance and Fortune. We'll continue bringing you more tips and strategies that could be game changers for your financial future. Don't miss out. Now, let's get into it. 1. Stay calm and avoid panic selling. In a bear market, the initial reaction for most people is panic. It's natural to see the value of your investments drop and want to hit the sell button to cut your losses. But here's what the ultra-wealthy know. Panic selling is one of the fastest ways to lose money in a downturn. Take Warren Buffett's famous advice. Be fearful when others are greedy, and be greedy when others are fearful. This doesn't mean throwing all your money into the market without thinking. It means staying calm and resisting the temptation to sell off your assets in a knee-jerk reaction. When you panic sell, you're locking in your losses. Bear markets come and go, and historically markets have always recovered. The rich understand that staying invested gives them the opportunity to benefit from the rebound. Instead of selling, the wealthy often rebalance their portfolios by adding more to stable assets or adjusting their risk. They plan, they prepare, but they don't panic. 2. Buy high-quality assets at a discount. Bear markets offer a unique opportunity to pick up quality assets at lower prices. The ultra-wealthy don't view market dips as a threat. They see them as an opportunity to buy more of what they believe in. For instance, legendary investors like Ray Dalio and Charlie Munger treat market downturns as a rare chance to acquire undervalued stocks. What do they look for? High-quality companies with strong fundamentals. These are businesses with solid balance sheets, healthy cash flows, and competitive advantages in their industries. During a bear market, even these top-tier companies can see their stock prices dip, giving savvy investors a chance to buy at a bargain. But this isn't a game of picking random stocks. The ultra-wealthy stick to companies that have weathered previous storms. Think of blue-chip stocks, market leaders in their sectors, or companies that provide essential goods and services. Key takeaway: focus on buying discounted assets that are built to last. Bear markets eventually end, and these quality investments are poised to thrive in the recovery phase. 3. Diversify beyond stocks. While stocks are often at the forefront of bear market discussions, the ultra-wealthy understand the importance of diversification. They know that putting all your eggs in one basket, especially in a single asset class like equities, can expose you to more risk. Instead, they spread their investments across various asset classes. This might include bonds. Bonds tend to perform better during market downturns, especially government bonds or investment-grade corporate bonds. Real estate. Property can offer a tangible asset that isn't directly tied to the fluctuations of the stock market. Commodities. Assets like gold and silver often act as safe havens during economic uncertainty. Private equity or venture capital. The ultra-wealthy often invest in private businesses or startups that have potential for long-term growth. By diversifying their portfolios, wealthy investors reduce their exposure to risk and create a more balanced investment strategy that can weather the storm of a bear market. 4. Use dollar-cost averaging. In uncertain markets, trying to time the bottom can feel like catching a falling knife. Instead of going all in on one day, the ultra-wealthy often employ a strategy known as dollar-cost averaging, DCA. What is it? DCA involves investing a fixed amount of money at regular intervals, regardless of the current price of the asset. This means you'll buy more shares when prices are low and fewer when prices are high. Over time, this smooths out the average cost of your investments. Here's why it works. In a bear market, prices are volatile. By using DCA, you avoid the emotional roller coaster of trying to predict market bottoms and tops. You consistently add to your portfolio, taking advantage of lower prices, and benefit when the market eventually rebounds. Many ultra-wealthy investors find DCA to be a stress-free way to invest during uncertain times, allowing them to stay committed to their long-term strategies without falling victim to fear or greed. 5. Focus on income-generating assets. Another secret of the ultra-wealthy in bear markets is their focus on income-generating investments. While stock prices may fluctuate wildly, assets that produce steady income offer a level of security and consistency that can help cushion the blow of a downturn. These assets include dividend-paying stocks. Even during market turbulence, some companies continue to pay dividends to shareholders, providing a reliable income stream. Real estate. Rental properties generate regular income that isn't tied directly to the performance of the stock market. Bonds. Interest payments from bonds offer a fixed income, especially valuable in times of volatility. By concentrating on investments that provide regular income, wealthy investors ensure they have cash flow coming in regardless of market performance. This gives them more flexibility to reinvest, hold on to assets, or simply weather the downturn without feeling pressured to sell at a loss. 6. Keep cash reserves. One often overlooked strategy that the ultra-wealthy employ is maintaining significant cash reserves during a bear market. Having cash on hand allows them to seize opportunities when they arise. When others are forced to sell assets at rock-bottom prices, wealthy investors with cash reserves can swoop in and buy undervalued stocks, properties, or businesses. They aren't tied down by liquidity issues, which often plague smaller investors during market downturns. Cash is also a buffer against uncertainty. It gives you the flexibility to stay invested while covering living expenses or other financial obligations without having to sell assets at the worst possible time. The lesson here is simple. Don't be fully invested all the time. Keep some cash on the sidelines so you can take advantage of market opportunities when they present themselves. 7. Take advantage of tax loss harvesting. Lastly, bear markets offer the ultra-wealthy a chance to implement tax loss harvesting, a strategy that allows investors to sell underperforming assets at a loss to offset taxable gains elsewhere in their portfolio. Here's how it works. When the market declines, some of your investments will inevitably lose value. Instead of just holding on to these losers, the ultra-wealthy sell them to realize a loss, which can be used to reduce the amount of taxes owed on capital gains from other investments. For example, if you sell a stock for a $10,000 loss, you can use that loss to offset $10,000 in capital gains, potentially saving thousands in taxes. Once they've harvested the loss, they'll often reinvest in similar assets, maintaining their overall strategy while still benefiting from the tax break. This is an effective way to make a bear market work in your favor, even when prices are down. Navigating a bear market can be challenging, but by applying the strategies used by the ultra-wealthy, you can not only protect your wealth, but potentially grow it. Whether it's avoiding panic selling, focusing on income-generating assets, or employing smart tax strategies, these methods can help you weather the storm and emerge stronger on the other side. If you found these insights helpful, don't forget to like this video and subscribe to Finance and Fortune. We're committed to bringing you more valuable content to help you master your investments and secure your financial future. Remember, bear markets don't last forever, but the strategies you use during them can set you up for success for years to come. Thanks for watching, and we'll see you in the next video.